Jeff Bangerter here with Bangerter Financial Services with the year in review. Stocks moved higher during a holiday-shortened week of trading, capping off a turbulent but otherwise strong year for the equity investors. The Dow Jones Industrial Average gained 1.35%, while the Standard & Poor's 500 increased 1.43%. The NASDAQ Composite Index, which led the year, added another 0.65%. The MSCI EFA Index, which is the overseas markets, rose 2.02%. The global pandemic disrupted economies, financial markets, and daily life in 2020. Households and businesses were put to the test during the toughest and grimiest year in decades. The winter brought a resolution to the U.S.-China tariff dispute, the Brexit referendum, and the first U.S. appearance of the novel coronavirus as spring started. But stay-at-home orders in response to COVID-19 curtailed business activity, which dampened consumer spending. The federal government responded, arranging stimulus payments for millions of Americans. Wall Street bounced back from its March downturn, but the economy limped along. The pandemic entered its worst phase in fall, but two highly promising vaccines were announced in November, and as the winter started, they began to roll out to the public. On the cusp of the 2021 Congress approved a second national economic stimulus, and the European Union and the United Kingdom signed off on a post-Brexit trade deal. There are many unanswered questions as we enter 2021. Will mass vaccination happen as quickly as we anticipate? Will a successful vaccine program lead to more hiring, more travel, more in-store shopping, and more confidence? The financial markets will be watching progress on this effect. The pandemic sent the U.S. economy into an abnormal phase, and so our fundamental economic indicators displayed atypical readings. The Department of Labor's main jobless rate, 3.5% in February, hit 14.7% by 7% by April. Headline unemployment declined for the next 7 months to 6.7% by November. The U6 unemployment rate, measuring unemployment and underemployment, peaked at 28.8% in April. As people stayed home, consumer spending trended lower, falling 6.9% in March and 12.6% in April. The federal government moved to boost the economic activity. As March ended, a $2 trillion economic stimulus bill became law, featuring cash payments to households, temporary increases in federal unemployment benefits, and a Small Business Administration program pledging to offer distressed companies funds equivalent to 8 weeks of payroll costs. The aid began to roll out in April, and in May, the White House unveiled Operation Warp Speed, a public-private partnership intended to produce COVID-19 vaccines in record time. 2 vaccines were approved by the Food and Drug Administration by fall. The Federal Reserve took the benchmark federal funds interest rate down to a target range of 0 to 0.25% and reviewed and revised the emergency procedures. The Department of Treasury on efforts to buy corporate bonds and encourage business loans. In monetary policy shift, the central bank said in August that it would accept average inflation of 2% for the near term and was willing to tolerate a little more inflation in the economy while pursuing the goal of full employment. As stay-at-home orders lifted, the economy rebounded. Gross domestic product, which the Bureau of Economic Analysis said had contracted 31.4% in the second quarter, grew 33.4% in the third quarter. The BEA also recorded a 41% Q3 climb for consumer spending. Stay-at-home orders returned in Q4, however, prompting another federal economic stimulus in December. The housing market stayed strong. By November, existing home sales were up 25.8% year over year, according to the National Association of Realtors. The Census Bureau data showed 20.8% annualized improvement for new home buying. The U.S.-China tariff dispute erased throughout the year, and in January of 2020 trade talks, the U.S. promised to lessen import taxes on Chinese goods, and China agreed to buy more American exports. The International Monetary Fund expects the world economy will contract 4.4% in 2020. If that estimate holds, 2020 will be the worst year for global growth since the 1930s. The U.S. economy shrank 4.3% in 2020. According to the IMF's forecast, that is better than the 8.3% setback estimated for the Eurozone. The IMF projects that China's economy grew 1.9% last year. As for 2021, it sees the GDP advances of 8.2% for China, 5.2% for the Eurozone, and 3.1% for the U.S. The European Union and United Kingdom agreed to a post-Brexit trade deal on December 24th. This completed the Brexit process, which began with the 2016 vote and included the UK's formal exit from the EU last January. Businesses and financial firms based in the UK now face new trade rules and costs, even with the new pact in place. Looking at stock benchmarks around the world, there were more ups than downs. South Korea's KOSPI composite stood out with a 30.75% 2020 gain. Argentina's Merval climbed 22.93%. Taiwan's TWII was 22.8%. Two other notable 2020 advances, Japan's Nikkei 225 added 16.01%, and China's Shanghai Composite rose 13.87%. France's the CAC 40 was 7.14%, Russia's RTS rose 10.42%, and Spain's IBEX 15.45%. The MSCI EFA index, a broad European index, rose 5.43%. So we join all Americans in happily drawing the curtain on 2020. Though it was a challenging and tragic year for so many, there are good reasons to believe that 2021 will be a year in progress and return to our pre-pandemic normal. We wish you and your family a healthy and happy new year. This is Jeff Bangerter with Bangerter Financial Services, home of the fiscal bridging formula, signing off for now.